All right. Well, good morning, everyone, or afternoon, as the case may be. My name is James Brody, and I'd first like to thank everyone for taking the time out of your busy schedules to attend today's webinar. With many in the industry recognizing that there is going to be a renewed focus on regulatory compliance issues with the swearing in of the new Biden administration, as well as the ever constant competition to attract the most talented loan officers to keep those production numbers up, we count ourselves fortunate to once again have the opportunity to collaborate with the Mortgage Collaborative and to co-host today's program titled Loan Officer Compensation Update, Tips and Trends to Gain a Competitive Edge in 2021 and Beyond. Although it goes without saying that there is only so much ground that we will be able to cover in the time that we have allotted for this program, I'm confident that you will find the material we cover today to be very informative as we all continue to navigate the ever important issue of loan officer compensation. Now, that being said, before we get into the meat of today's presentation, I want to provide some information about myself and Johnston Thomas, as well as provide some time for our co-host, Thomas Gallucci, to introduce himself and the Mortgage Collaborative. Now, as to the proviso, what type of attorney would I be if I did not first take a moment to give you the standard disclaimer that nothing in today's presentation constitutes legal advice or creates an attorney-client relationship. Still, should you have any follow-up questions at the conclusion of today's program, I welcome you to send such to my attention, and we will also be sure to prepare and provide a complimentary follow-up FAQ memo for all of today's attendees. As for myself, I am the chairman of Johnston Thomas's Mortgage Banking Practice Group, where I manage and oversee all the complex mortgage banking litigation, mitigation, licensing, and all manner of regulatory compliance matters for our diverse clientele of lenders, brokers, credit unions, and financial industry vendors from all across the country. Amongst the many legal services that Johnston Thomas offers the mortgage banking industry, these include, but are in no way limited to, assisting our clientele with their regulatory compliance needs, from crafting and negotiating loan purchase agreements and seller's guides, to drafting LMLO compensation agreements and MSAs, to conducting mock CFPB audits, to helping with our clients' multi-state licensing needs. And in addition, while our compliance practice tends to be forward-looking, we are also heavily involved in more backwards-looking services, such as defending lenders and brokers against reps and warrants claims, pursuing everyone involved in the financial transactions to the extent they cause harm to our clients, and much more. Now, for our co-host, which should not need any introduction given their prominent involvement in our industry, including their hundreds of lender members and partner vendors, still with us today we have Mr. Thomas Gallucci, the Senior Vice President of Business Development for TMC. Tom, if you wouldn't mind giving us a brief introduction to yourself and TMC, as well as maybe a little bit of information on how TMC is helping its members and the industry at large address the ever-present compliance and many other needs.
James, thanks so much for the introduction and really appreciate the opportunity to help co-host you today. And, before introducing myself, just want to sing the praises of Johnston Thomas, who's been a great partner with the Mortgage Collaborative, really in particular with your mortgage banking group and helping support our members in regards to the regulatory compliance matters, defense against consumer actions, repurchase issues, and negotiation and preparation of their agreements as well. It's been just a fantastic partnership and the support that you've provided to the Mortgage Collaborative and our members. I can't thank you on behalf of the cooperative enough here. About me, as James, a great introduction here, mentioned Senior Vice President, Business Development with the Mortgage Collaborative, been with the cooperative just over 5 years now, and I have the pleasure of managing our preferred partner network, which spans really across the mortgage origination life cycle, where TMC partners with different third parties, really best-in-class organizations that can help support mortgage lenders across the origination lifecycle with outsourcing some of their needs to operate more efficiently and more profitably, which has never been more important in this margin compression focused environment that we are currently facing within the mortgage industry. Did you proceed to the next slide for me? Quickly on the Mortgage Collaborative, we are the nation's largest independent cooperative serving the mortgage industry. As I mentioned, built up of more than 65 preferred partner organizations and now spanning more than 230 lender member organizations across the country. And I think really lenders get a ton of value from the collaborative based on our philosophy, and it's really focused for our members by our members, and that's really what we live by, in creating that environment of collaboration and experience and benefits and opportunities and education, truly focused on the needs as driven to us by our members in kind of this pay it forward culture that really fosters a lot of idea sharing and allows our membership to feel that they're part of a familial type culture and can leverage really the expertise of their peers to better run their operations. If you proceed to the next slide for me. So I'll go very briefly through just a couple direct benefits of the Mortgage Collaborative membership. On this page in particular, you can see kind of a breakdown of some of those key opportunities within the membership. And the one I'll highlight on here would be our preferred partner organizations, where our lender members are able to take advantage of unique benefits, discounts, or even co-initiatives with our preferred partners that they're currently working with, really made up of the best-in-class organizations within our industry. Next slide, please. So real quickly on TMC benchmark, this is one of the biggest drivers of value to the lender members of the Mortgage Collaborative, as evidenced by having more than 100 members of the collaborative using the tool. And it's basically a great way on a ease of use, ease to read, ease to submit from a reporting standpoint. Well, our members get to see on a monthly basis about 50 key performance indicators central to running their mortgage operation on the operations production and accounting side, where they can, in as little as 20 minutes, or even through some some automated options available through our partners at LBAware, be able to see how they're performing against the Mortgage Collaborative network as a whole, and then also broken down into smaller peer groups sized similarly to the scope of operation for their lending institution. And the best part of it is it's a complementary benefit of the collaborative membership. Next slide, please. And then TMC Connect. This is our educational networking platform. And if you ever visit the Mortgage Collaborative website, highly encourage you to check out our member event calendar, where it's being updated daily, where we're bringing together really the most insightful subject matter experts within our network from both our preferred partners and lender members on a daily basis to really dive into a lot of the hot button topics like today's discussion on loan originator compensation that are challenging our industry right now. And it's a great collection of discussion leaders from both our preferred partners and lender members, focusing on really their shared experiences, help identifying emerging trends and issues, and keeping TMC members at the forefront from where our industry is heading. And again, another completely free benefit of membership to our lender members and preferred partner companies. Next slide, please. And then the working groups at TMC, networking groups for like-minded professionals, kind of networking within the network, if you will, where we've crafted either monthly or every other month recurring conference calls between segmented professionals focused in the areas that you'll see specifically on your screen, covering our HR professionals, our Community First working group, which has a distinct focus on professionals in the CRA segment of the industry. We have operational excellence for your ops management, capital markets, marketing professionals working group, as well as loan servicing, and our women's networking groups. And the great part about this is these recurring conference calls, the content and topics are dictated solely by our participating members. So it really again, dovetails back to the ethos of the Mortgage Collaborative, that we look to drive our content and benefit direction of the organization based on the feedback of our members and how we can best benefit the organizations that support us. Next slide. And I'd be remiss if I didn't give a shameless plug to our biannual member conferences. By far the largest benefit that both preferred partners and lender members get from TMC. And happy to say that we're coming back live in person September 18th through the 21st at the immaculate Terranea Resort in Southern California. We're like just about everything we do. The agenda and the experience for the event is truly driven by the feedback from our lender members in a highly interactive format, where the goal of every conference is to allow both our members and our preferred partners to walk away stronger with great business opportunities, but also armed with ideas, strategies, and relationships that help leverage them better operate their organization and walk away with strategies that they can implement immediately to improve their operation. Next slide. And lastly, our collaboration labs. These have been a really great opportunity for our lender members to pick the brains of their peers, especially at the C-suite level, where we've got more than 80 of our members participating in these labs, really consistent of like size and minded organizations that don't directly compete with one another. So it allows these key executives within our membership to really get under the hood of their operations and do a real intentional deep dive based on the content that they want to cover on how they can leverage the mutual experiences one another are facing within our industry and compare similar metrics to understand where they can implement strategies that are going to help them operate better, as well as a robust sharing of third-party experiences, predominantly within our preferred partner network. So these continue to grow and have been a huge boon to our lender executives that are participating within the Mortgage Collaborative. And James, I just want to thank you again here, and a quick plug for Johnston Thomas too, for either current or hopefully future Mortgage Collaborative members. A great benefit of our partnership with Johnston Thomas is not only does James' organization provide discounts on their services through the legal organization, but also offers collaborative members a pair of complimentary 30-minute consultations with James and his team on an annual basis. So it's been such a huge boon to our members to help just kind of understand how they navigate the current regulatory market with a legal expert just like James. So James, thank you again for the opportunity, and I will turn it back over to you.
All right. Well, listen, thank you very much, Tom. I definitely appreciate that. And for anyone who's interested in learning more about TMC, needless to say, there's going to be a courtesy copy of our PowerPoint that will be made available to all of today's attendees, along with a follow-up FAQ memo that we will prepare in response to any questions that we receive following today's webinar, given the fact that with the amount of material we have to cover, we simply are not going to have much time for any Q&A. So without further ado, as much as everyone would like to see the events of 2020 through the rearview mirror, COVID-19, a contentious presidential election, and so on and so forth, it's clear that 2020 proved to be a record-breaking year for production and profits in the industry. Now, albeit this increased production was a silver lining of 2020, many in our industry spent more of their time and attention on meeting their increased hiring needs than they did on meeting their ongoing regulatory compliance needs. Now, still, with our slowly but surely moving past the trials and tribulations of 2020, the increase in regulatory scrutiny promised by the new Biden administration and leadership at the CFPB looms large. Accordingly, today's webinar is meant to focus on the loan originator compensation rule, what can be done to remain both competitive and compliant, as well as to generally cover what are the CFPB's hot button issues insofar as loan officer compensation is concerned. Now, needless to say, we receive frequent questions from industry professionals, and those questions have guided us in developing today's agenda. As part of the webinar, we're going to look at the rule's purpose, the key elements of the rule, the prohibited and permitted compensation structures, varying LO comp by loan product, compensation pools, point banks, proxies of loan terms, clawbacks for loan quality, EPO, EPD clawbacks, revisions to compensation plans, paying LOs as independent contractors, unforeseen settlement costs, pick-up plan structures, permitted profit-based compensation, recent enforcement actions, and lastly, how UDAP plays a role in loan officer compensation. In other words, most of the hot button issues concerning the ever important issue of loan officer compensation. Now, the stated purpose of the rule, the CFPB's loan originator compensation rule, which had gone into effect in January of 2014, had the stated purpose of, at least according to the CFPB's own small lender LO comp compliance guide, was and is to prevent steering and protect consumers. In other words, the CFPB aims to prevent organizations from steering borrowers into higher cost loans that the borrowers might not really need, just so the LO can make more money on the deal. Now, the guide rightly points out that this practice of steering borrowers was extremely common leading into the housing crisis. Still, despite the fact that the rule has been in place for years now, some lenders, many lenders, are still struggling to comply with it and its many nuances. And to be fair, the rule itself is fairly vague, and the guidance offered by the regulators is, as is typical for many guidance offered by regulators, not much better. Now, as a rule, the most common questions our compliance attorneys receive on a weekly, if not daily basis, even in 2021, concern loan officer compensation issues. Now, having stated the purpose of the rule, we would now want to look at the two primary ways that the rule is meant to accomplish its purpose. First, the rule prohibits a lender from compensating an LO based on loan terms or a proxy for loan terms other than loan amount. We'll talk more in a moment about exactly what a proxy is. Second, the rule prohibits compensation from both the consumer and the lender. Although there are some other provisions we'll get into today, most of the questions we receive fall under that first key element, that being that the loan originator compensation cannot be based on a loan term of a transaction or a proxy of a loan term. Whatever you want to call your compensation, whatever you say you're basing it on, however far removed, the primary question is whether the compensation is tied to the loan terms, which is what the CFPB is ultimately looking for in its examinations, in which most LO comp rule enforcement actions have been and continue to be based on. Now, to help everyone better understand the rule and its many nuances, much of today's webinar is scenario driven. Fortunately, as we receive numerous calls asking for help in understanding the LO comp rule, we've collected these questions and designed the format of this webinar based on the questions we most receive. Of course, if anyone on today's call has a question that we don't get to, please feel free to send us an email with your question, and we will do our best to promptly address that within our forthcoming FAQ memo that we will again prepare subsequent to this webinar for all of today's registrants. Now, after starting with what's available, we will then cover what are considered permissible actions, prohibited actions, what are more questionable actions, kind of falling in that gray area, highlight when you should proceed with caution, and go over some of the most relevant enforcement actions before finally covering UDAP and how it fits into the LO comp analysis. With all the regulation uncertainty today, it's frequently overlooked that the LO comp rule itself outlines a number of methods for compensating LOs, which methods are effectively safe harbors for lenders. In short, the rule outlines 7 methods for paying compensation that are not considered to be based on transaction terms or proxies for transaction terms. Again, the buzzwords there. 3 of the methods are fairly commonplace, including compensation based on overall dollar volume, hourly pay rate based on number of hours worked, and fixed amounts such as $600 for every credit transaction arranged for the creditor, or $1,000 for the first 1,000 credit transactions arranged, and $500 for each additional credit transaction arranged. The other 4 methods outlined in the rule are frequently overlooked and definitely underutilized. These methods include the long-term performance of the originator's loans, new versus existing customers, percentage of applications that close, and the quality of the loan originator's files, such as accuracy and completeness of the loan documentation, which ends up costing lenders a lot of money, and which is the genesis for the big question we always get about how to do a clawback. Still, all 7 of the outlined methods can be used in conjunction to achieve the lender's goals. Now, with regard to permissible compensation structures, some things that are clearly permissible include the payment of different compensation structures for different LOs. One question we frequently get is whether our clients can pay their originators in the same state or the same branch different amounts. And the answer is quite simply yes. Some originators are simply better than others. It's the fact of life. And the amount you pay to each may vary from one state to another, or even within the same branch. You have to be able to pay your talent according to their abilities, and there is no requirement that you pay all your originators the same amount. Rather, you need to ensure that whatever you pay any given loan originator, that this complies with the loan originator compensation rule. Compensation must not be based on a term or a proxy. You can't get dual compensation, and so on. Now, what about toggling? With regard to the issue of toggling, we're frequently asked whether you can allow an originator to choose borrower-paid compensation on one transaction and lender-paid compensation on another transaction in the same day or month. And the answer here, too, is yes. Your loan originator can toggle back and forth between borrower-paid and broker-paid or lender-paid from transaction to transaction. In other words, according to the rule and its commentary, the prohibition against dual compensation is transaction specific. Next, can you set a minimum or maximum dollar amount of compensation? And again, the answer here too is yes. As long as the floor and the cap do not vary with each transaction. For example, a creditor can offer an LO 1% of the loan amount on all loans, but not less than $1,000 or greater than $5,000 for each loan. Now, what about guaranteed specific benchmark bonuses? Well, let's suppose an LO's employment agreement guarantees a quarterly bonus in a specific amount based on reaching a predetermined volume of originations on a monthly basis. Well, it's not based directly or indirectly on transaction terms because the creditor is obligated to pay it regardless of loan terms or their effect on the creditor's profits. Plus, since it's not connected to profits, it's not subject to the 10% limit, which we'll also be getting into in just a few moments. Now, what about sign-on and retention bonuses? Well, let's say, for example, you wanted to pay a sign-on bonus or a retention bonus. As long as your bonuses are not based on profits, you're okay. Tax advantage plans and permissible non-deferred profits-based plans are exceptions to the prohibition against compensation based on the terms of multiple transactions by multiple LOs, i.e. profits. If you're not basing the bonuses on profits, you don't need the exception. Still, you should budget for these bonuses in advance and set them aside at the beginning of your annual accounting period. Like many instructions we've given in this webinar and will be given in this webinar, this is more than a suggestion. Specifically, as budgeting in advance is expressly mentioned in the CFPB's examples of acceptable bonus structures, it should be considered a requirement. Pick-up plan structures. Okay, another question our clients ask is whether they can have a pick-up plan payment structure where the LO gets to pick a compensation plan. The answer again here is yes. There is nothing in the LO comp rule that prohibits lenders from letting their LOs pick a comprehensive plan. In fact, we routinely draft this language into our clients' compensation agreements. In this slide, we set forth an example of what pick-up plan contract provisions look like. As you can see in this particular agreement, the loan originator has the option of having a comp plan based on the lender providing him or her with a loan assistant, or picking another plan that pays the originator a higher amount if the company does not have to provide an LO assistant. Now, this is just one example of a pick-up plan payment structure and the many other options that are actually available to lenders to help you, again, remain competitive and compliant. Designated tax advantage plans. Okay, you remember that from earlier on in this webinar that compensating LOs based on multiple transactions by multiple LOs is prohibited. The CFPB provides for two narrow and limited exceptions to this prohibition. First, the Bureau allows for designated tax advantage plans. These are plans that meet specific IRS guidelines like 401ks. Now, keep in mind, however, contributions cannot be directly or indirectly based on the terms of an individual LO's transactions. Now, the other exception is for non-deferred profits-based compensation plans. An example might be a creditor paying an individual LO year-end bonuses that based on the creditor's average net return on assets for that year. Again, compensation to an individual cannot be directly or indirectly based on the terms of that individual LO's transactions, and either one, capped at 10% of the LO's total comp for that same period, or two, the individual LO was an LO for 10 or fewer transactions during the preceding 12-month period. Now, profits on which the compensation is based can include affiliate profits. Also, awards of merchandise, services, trips, or similar prizes or incentives where these awards are determined with reference to profits are counted toward the 10%. If the plan is determined with reference only to profits from businesses other than mortgage-related businesses, the 10% cap does not apply. As a result, the rules affecting how these plans are set up are numerous and complex, which is the very reason why it is always advisable to ensure that your intended LO comp plans are fully vetted by your legal counsel that understands, not only the law, but also the business, because at the end of the day, that's what you need, is to have counsel and vendors and partners who understand, both the business side as well as their relevant areas of expertise. All right, now the P&L branch model exercise. Now that we've gone through some examples of what is and isn't prohibited, as well as some of the gray areas in between, let's take a quick look at a question we received very recently regarding this particular webinar. Specifically, we were asked whether we would be addressing the P&L branch model in this webinar, and where the producing branch manager shares in profitability by the companies setting the branch manager's comp at the total revenue to the branch and then deducting branch overhead and costs. And the branch manager receives the balance. As the party in question advised, it often comes up against this model in its recruiting efforts, which is very similar to the old net branch model from the 80s and 90s, and possibly even a little bit later. Now let's go through the analysis. First, is the branch manager a loan originator? And here, yes. In this scenario presented, he is a producing branch manager. Next, is the branch manager being compensated directly or indirectly in an amount that is based on the terms of multiple transactions by multiple individual LOs? And it appears so in this scenario. Total revenue would certainly be based on the terms of multiple transactions by multiple originators. Third, is it a permitted non-deferred compensation plan? Well, there's no mention of an established plan here. And so, taking the foregoing into account, it appears that this would violate the rule. Although the manager could be compensated under a plan, you would have to change the manager's overall compensation structure in order to do so. In other words, maybe pay the manager a fixed percentage of his or her originations and then provide a bonus capped at 10% or limit the number of originations. Now, we're not making a blanket statement that every variation on the net branch model violates the rule. The facts of each situation must, of course, be judged on their own. However, simply funneling things through an expense account will most definitely not insulate you, as you'll see from the enforcement actions that we're going to talk about here shortly. Now, the CFPB has given us 7 safe harbor examples that are not a proxy for a loan term. But first, what is a proxy? The answer is that a factor, which is not itself a term of a transaction, is a proxy for a term of a transaction if the factor consistently varies with a term or terms of the transaction over a significant number of transactions, and the loan originator has the ability, directly or indirectly, to add, drop, or change the factor when originating the transaction. It's a two-part test. So let's go over it again. A factor that is not itself a term of transaction is a proxy for a term of a transaction if the factor consistently varies with the term or terms of the transaction over a significant number of transactions, and the loan originator has the ability, directly or indirectly, to add, drop, or change the factor when originating the transaction. So applying the two-part test to the sold versus portfolio example, the first prong of the analysis is met because the factor consistently varies with one or more transaction terms, namely that portfolio loans have a lower rate and a shorter term over a significant number of transactions. Now, the second prong is met because the LO has the ability to direct the consumer to choose a 5-year balloon over a 30-year fixed. So varying LO comp according to whether a loan is held in portfolio or sold would be basing LO comp on a proxy of a loan term and thus is prohibited by the rule. Other examples typically lead to a similar result because they all tend to have different terms. Qualified mortgages versus non-qualified mortgages, FHA versus conventional, bond programs which have interest rate limitations versus non-bond programs, Community Reinvestment Act versus non-CRA. Even basing compensation on the DTI or the LTV could be considered compensation based on a proxy. These factors could consistently vary over a significant number of transactions with a term such as the interest rate. As a result, an LO could have the ability to alter these factors by encouraging consumers to take out larger or smaller amounts of credit. Okay, now prohibited compensation structures, varying LO comp by loan product. So let's dive right in here. Can you pay an LO more for one type of a loan product than another? Again, no. Remember that the loan originator compensation rule prohibits basing the LO's comp on a term of the loan. Terms include interest rate, APR, qualifying credit score, amongst many others. And a loan product is essentially just a bundle of terms. So if you vary your LO's compensation by loan product, and you're not just violating the rule by basing the comp on one loan term, chances are you are basing the pricing on a few loan terms, which make up that bundle of terms that we call, again, a loan product. Compensation pools. What about paying a bonus to an LO out of a bonus pool that's based on the lender's profits from all of its LOs? Can't do it. You would simply be compensating based on the terms of multiple transactions by multiple LOs. The CFPB makes this explicit in the rule. They provide exceptions for two types of profit-based compensation, but those are narrow and limited, and we'll get into those in a moment. All right, the buzzword, the issue of point banks. Over the years, some lenders have used point banks. Well, maybe a lot of lenders had used point banks. And with a point bank system, a lender maintains account balances, usually using basis points that are credited to an LO's account for any number of performance-based factors. The idea is for LOs to cash in on those points for loans on which they wouldn't make as much compared to others. Now, it's probably not the best idea to try to come up with a point bank system that would be compliant. We know what the CFPB thinks of them because they've told us in the preamble to the rule. In short, the CFPB believes there should be no circumstances under which point banks are permissible. Not too ambiguous. Now, but that doesn't mean you can't incentivize your top talent. Pay changes can be based on past performance, similar to hourly or salary raises. Lenders should be careful not to allow frequent changes, however, to an LO's comp plan. Now, the rule doesn't specify a frequency that is per se permissible, although it mentions reviewing the plans every 6 months. Frequent changes to an LO's comp levels may indicate that the company is paying loan term based compensation. In addition, Mortgage companies should keep their eye on fair lending or steering risks of having different LOs offering different loan terms. The companies should ensure that all their prospective borrowers are treated fairly. To mitigate this risk, lenders should create and implement precise policy and procedures tracking any exceptions or deviations from that policy. Now, how about scaling LO comp up as the loan amount goes down? What might be called a tiered compensation structure. Now, when paying loan originator compensation based on a percentage of the loan amount of specific transactions, the percentage must be fixed and cannot vary with the amount of credit extended. You can't offer an LO 1% for loans of 300K or more, 2% for loans between 200 and 300K, and 3% on loans of 200K or less. This is expressly prohibited in the commentary to the rule. In contrast, when compensating LOs based on overall dollar volume of loans, that structure can be tiered. As you'll see in a moment, overall dollar volume is one of the safe harbors. In other words, it's expressly not a proxy of a loan term, which we will again define here shortly. Okay, sold versus portfolio. What about basing LO comp on whether that loan is held in portfolio or sold to the secondary? Typically, lenders choose whether to sell or hold a loan based on the loan's terms. For example, holding in portfolio 5-year balloons, but selling 30-year fixed and have a higher interest rate. And the LO usually advises the borrower which type of loan to choose. This is what is known as a proxy, and the CFPB uses this very scenario as an illustration for what a proxy is. Now, let's get into some of the more questionable practices, maybe the gray areas. These are things which, while they might not be explicitly prohibited, we consider them to be highly risky, and we always caution against them. Now, some of these practices granted, may be more questionable than others. There is some level of relativity here. What about clawbacks for quality of the LO's files? A favorite question that we get, incessantly, and it makes sense. You have an LO, they're being sloppy, they're doing bad work for whatever reason. Maybe it's just a simple mistake, maybe it's a more, a systemic problem. And it's costing you money. Now, basically, when LO goes ahead and makes a lot of these documentation errors, they're often related to loan terms or their disclosure. These LOs can be rock stars when it comes to sales, so that the client does not want to get rid of them, but their documentation errors are resulting in unsellable loans and are costing a hell of a lot of money. Excuse my language. Oftentimes, these inquiries will come with a statement from the lender that the LO is specifically asking to be able to pay back some of their compensation to the lender. You might think that the safe harbor provision on quality of loan files permits penalizing the LO on specific transactions. However, that's not the case. The Bureau has commented that the safe harbor provision on quality of loan files permits adjustments to be calculated with reference to and applied to multiple transactions. Thus, it doesn't appear that the safe harbor provision on loan quality contemplates transaction by transaction adjustments. There are some in the industry who make a distinction based on the kind of error made. They endorse penalizing an LO on a specific transaction for failing to deliver a disclosure in the required time frame, or failing to include a necessary loan document in the closing package on the one hand, and opposing penalizing an LO for disclosing the wrong interest rate or fees on the other. The reason they make this distinction is because losing the safe harbor protection just means you're not insulated from the proxy test. So the real concern is whether you're actually changing compensation based on a proxy for a transaction term. Even the CFPB itself has stated that it might be permissible to reduce LO comp as a penalty for failing to follow policies where there is no loss to the creditor and transaction terms don't change. However, in the rule itself, transaction-specific reductions are expressly allowed only in limited circumstances, which we'll get into here shortly. Now, the CFPB has further commented that these situations with loan quality are better addressed separately by the LO and creditor outside of the context of that transaction or transactions. Is there anything you can do to recoup your losses for your LOs who are making documentation errors and are costing you money and know you're safe? The answer here is yes. What you can do is build a quality factor into your LO comp structure and specifically into your LO comp agreements. Now, for example, your agreement might provide in month 1, your LO will only receive a 2.5% commission. If no documentation errors are made that month, then the following month, month 2, your LO will receive 3% on loans closed during that second month. If documentation errors occur in month 2, then the commission for month 3 will drop down to 2.5% again, and so on. Now, variations on this model exist, but the point is that you can introduce a quality factor into your compensation scheme that will help ensure that your originators produce quality loans with good documentation. Now, this won't allow you to recover the exact amount you may have lost, for example, on a given loan because of a repurchase demand, but over time, it can recover some money for these types of losses. It will also help you to identify LOs who consistently make errors on their loans so that you can evaluate your options as it relates to continuing to employ that person. So moving into the related issue of EPOs, EPDs, and clawbacks. So another frequently asked question is whether you can claw back commissions for an early payoff or early payment default. And technically, well, the answer is yes, you can, because EPOs and EPDs are not loan terms under the LO comp rule. So technically, you can adjust commission based on these factors. But even though the technical answer is yes, you can claw back for an EPO or EPD, the bigger question is, should you? And we say no for several reasons. First, while EPOs and EPDs are not loan terms, since they are events that arise after origination and are not part of the bundle of loan terms that make up a product, clawbacks based on EPOs and EPDs will ultimately refer back to a specific transaction. In other words, to a specific loan. These clawbacks also raise potential proxy issues. If your LO happens to make the same mistake on certain kinds of loans, you run the risk of an examiner coming in and finding an unintentional, inadvertent pattern in your LO's mistakes that suggests he or she was making the pricing mistakes in favor of one type of borrower over that of another. Next, an EPO or EPD clawback is technically inconsistent with another part of the LO comp rule. Specifically, the LO comp rule is supposed to be set, or the LO comp is supposed to be set in advance. So any clawback will necessarily involve modifying a commission that was previously agreed to. Another concern with EPO or EPD clawbacks involves employment laws, which sometimes define when a commission is, quote, earned for purposes of labor law. Now, your clawback may, therefore, be clawing back at a commission which your state's labor laws says was already earned by your employee. All right, frequent revisions to comp plans. I think we briefly mentioned it, but one of the things, again, we commonly advise our clients is that they should not allow frequent changes to an LO's comp plan. Frequent changes to an LO comp plan can and normally do serve as red flags to the regulators, since frequent changes can, again, suggest that you are really paying compensation based on loan terms. Now, the notion here is that you may be revising the comp plan to try to mirror an LO's actual profitability on a monthly or quarterly basis, or that your comp plan is really just trying to play catch up with how much the LO is actually making on the loans. For this reason, we believe the safest route is to adjust the comp once a year or maybe once every 6 months, but not more often than that, unless you are willing to accept that additional scrutiny that will surely come from the examiners. And as the CFPB is interested in making sure adjustments aren't made to correlate with loan terms, please Be sure and document the reasons for the change. If you're increasing an LO's percentage because of the volume of business produced by that originator, document it. That way, even if loans may generally carry a higher interest rate after that date, you can show a valid reason for the change. So what about paying LOs differently for purchases versus refinances? Well, this situation is a little bit tricky. I mean, there are some in the mortgage industry and some attorneys as well who suggest that a lender can pay originators different amounts for purchase loans versus refis. The rule has a safe harbor for new versus existing customers, and regulators say informally that they are unlikely to be concerned about compensation for purchase money loans versus refis, since it is unlikely that the LO could influence which type of loan the prospective borrower originates. The idea here is that if a client walks into your branch or calls your branch asking about a refi, the LO is not going to be able to, quote, steer them into a purchase loan or vice versa. However, the CFPB has been reluctant to provide a categorical exemption. That's the first reason we advise against paying your LOs differently on purchase loans versus refis. Second is the discussion we just had about a loan product being simply a bundle of terms, which comes straight from the CFPB's small lender compliance guide. So the limited guidance the CFPB is giving is that it considers loan products to be a bundle of terms, and a refi is as much a bundle of terms as any other loan product. All right, what about paying an LO as an independent contractor? While technically there is no law prohibiting you from paying your LO originators as independent contractors, and we know that some lenders on the market are in fact doing so, we strongly recommend against it. There are some states which have state laws that specifically allow loan originators to be independent contractors. In addition, the commentary to Reg Z at section 1026.36, I could keep going on, but it's probably better for you just to obtain a copy of the deck so that you can pull that. It appears to assume that at least some lenders are paying loan originators as independent contractors. And this slide sets out the language we're referring to. Let's see. Okay. For purposes of section 1026, the individual loan originator's total comp consists of the sum of total of 1, all wages and tips reportable on IRS Form W-2, or if the individual loan originator is an independent contractor, reportable compensation on IRS Form 1099. And despite this language that suggests that at least some loan originators are being paid as independent contractors, we continue to advise against it, and we consider doing it very high risk. According to the IRS, a person is not an independent contractor if he or she performs services that can be controlled by an employer, i.e. what will be done and how it will be done. What matters is that the employer has the legal right to control the details of how services are performed. And the general rule is that an individual is an independent contractor if the payer has the right to direct only the result of the work and not what will be done and how it will be done. As an example, you can contract with an independent contractor to build you a swimming pool. But with an independent contractor, you're not going to be controlling the day-to-day minutia of how that contractor is going to build the pool. Mortgage lenders must regularly account for what compensation their originators are making. But with independent contractors, you cannot realistically know what compensation the originators are making on the side. With an independent contractor, there's also less visibility to conflicts of interest that independent contractor might have as it relates to your clients. There is also less visibility to the status of the originator's license or disciplinary matters that may arise as against your IC. This overall lack of control over ICs is inconsistent with our highly regulated industry. So in light of that, it's exceptionally difficult for a lender to realistically argue to a regulator that a loan officer is an independent contractor and that the lender doesn't control what the LO does or how the LO performs their duties. This is because both lenders and examiners require LOs to follow company policies and procedures including those that relate to safeguarding consumers' private information. Now, for these reasons, we again routinely advise clients against hiring LOs as ICs. All right. Now, let's move to some practices which may be acceptable but do merit some extra caution. Now, these are things which can be done, but again, be careful that you're doing them right. LO comp reduction to cover fees. An LO may decrease its compensation to cover unforeseen settlement costs or unforeseen settlement cost increases. The key word here is unforeseen. These are costs that typically arise after the loan estimate is provided, in spite of the originator's reliance on the best information available at that time, but that wouldn't qualify for a change of circumstance. Now, suppose a borrower locks in their interest rate on a purchase. An unforeseen title issue delays closing by a week, causing the lock to expire. The borrower wants to relock, but there's a fee. Can the LO cover it with a reduction? The answer here is yes, as long as the title issue was unforeseen. Same goes for curing tolerance violations under RESPA, provided the violation was unforeseen. Was the disclosure consistent with the best information reasonably available? It's worth mentioning that TRID 2.0 clarified the CFPB stance on allowing borrowers to pay for rate lock extensions when it is a result of a valid change of circumstances. What the examiners will be looking for is a pattern or practice of the LO repeatedly decreasing their compensation to defray the cost for the same categories on multiple transactions. Now, this is the same for concession practices. A company may discount, they can't lower their own commission to lower cost of consumer, but not the LO. If the LO is allowed to then to vary in terms directly and clearly controlled by the LO, so be sure that the reduction is documented along with the reasons for it. This is not a suggestion, this is a requirement. The record retention rules specifically set this forth. Now, can you pay a loan originator who originates loans in one state more than another originator who originates in a different state when both originators are in the same branch office? While technically the answer is yes, you can pay your originators differently based on their talent levels. You have to be careful here. It's been a long accepted practice for multi-state lenders to allow market conditions to dictate compensation for LOs in branches located in different states. But market conditions can also vary across or even with MSAs. As such, some lenders are offering different compensation based on the MSA where the LO or branch is located, and others are even segmenting compensation based on market conditions within segments of an MSA. There is nothing in the LO comp rule that prohibits a lender from varying compensation among different loan officers so long as payment variations are, again, not related to terms and conditions of a loan or a proxy thereof. Such variances might be attributed to experience, market differences, variations in overhead costs, as well as other reasons. But it is also prudent to monitor compensation practices and how they affect the consumer to ensure that these variances do not result in fair lending issues. Even though CFPB commentary states that geography would not usually be a proxy, regulators will examine not just one loan for compliance with the LO comp rule, but may examine a large batch of loans. If that examination reveals that the loans in the state tend to have lower credit scores and higher interest rates than in another state, then the examiner might conclude that you are, via proxy, rewarding your originator for for originating higher cost loans to borrowers with poor credit scores. In these instances, lenders must be sure to thoroughly document the reason behind the differentiation in order to avoid the implication of redlining, which is verbatim under the fair lending rules. Lenders would also be wise to seek a legal opinion if they utilize this type of comp criteria, just to ensure that you have a legally defensible position should questions ever arise regarding your specific process and actions. The possible scenarios here are really, endless, but the point is to be careful about factors you're trying you're tying to a loan officer's compensation. Okay, bond loans. Since we just mentioned fair lending, let's talk a little bit about bond loans and down payment assistance programs for a moment. Generally, bond loans and DPA programs are subsidized by a mortgage revenue bond or contract activities issued by state and local governments to help qualified low and moderate income home buyers. Bond loans tend to be extremely limited regarding fees and profitability. LO commission percentage can exceed revenues earned. Losing money on each deal disincentivizes companies from offering these products. Now, as I mentioned, nothing in the loan officer compensation rule prohibits a lender from varying comp among different loan officers. So long as the payment variations are not related to terms and conditions of a loan or a proxy thereof. Now, the CFPB assumes the loan officer influences product selection because a proxy is something which varies with the terms and conditions of a loan, and the LO has the ability to influence that something. This is considered a proxy for a loan term. And some argue product selection can be out of the LO's control if the borrower only qualifies for a certain kind of loan. Now, it's been an industry rumor for years that the regulators were going to reevaluate LO comp for bond loans, and they still might. The CFPB has stated that they are considering a reevaluation of LO comp in the future. But until that time comes, many lenders have chosen to create salaried positions in which the LO only originates less profitable products like reverse mortgages, home equity lines of credit, bond-funded loans, and construction loans to avoid having to pay out more in commission than the loan will ultimately bring in profit. This is permissible. Okay. Another question we commonly receive is, can a creditor vary the compensation it pays its originator employees based on whether the creditor provides the lead or the employee self-generated the lead? This is most likely permitted as the source of the lead is not itself a term of a transaction. And it's probably not a proxy here because this method of compensation fails the second part of that proxy analysis, as there is no ability to change the number of creditor provided leads. Now let's go through a couple of examples for refinance versus purchase. Previously the CFPB stated that there isn't a real possibility for influencing a consumer to buy over refinancing. How about company-generated leads versus LO's efforts? Consumer direct internet unique business sources, or are commonly referred to as business channels, have different costs associated with them. Now, it's common to see lower commission rates for loans coming through a house channel. These compensation variations are not terms of the loans offered to the consumers and wouldn't be a variation that the LO could influence. Why do we say proceed with caution here then? The question of leads often overlaps with the question of referrals. As you'll see later in this presentation, it's easy to respond. It's easy to become so focused on the LO comp rule and forget about ordinary RESPA kickbacks. Always be sure there are no kickbacks for referrals. There must be a business reason, and it must be, again, defensible. CFPB enforcement actions. The regulator's favorite way to help explain what they want you to do by punishing those who fail to do that. In late 2015, the Deputy Assistant Director for Originations at the CFPB, Calvin Hagens, indicated that loan officer compensation would be one of the CFPB's major focuses in 2016. Despite that ominous announcement, the CFPB was quiet about LO comp enforcement that year, and the news headlines focused instead on other topics, including allegations that Wells Fargo had aggressively pushed bank accounts onto customers that may not have really wanted them. Despite things being quiet in the news, a number of our clients and the clients of other attorneys we work with reported that LO comp was coming up in their examinations. So while LO comp wasn't making headlines, the CFPB was still looking into lenders' comp plans, all the way back in 2016. So lenders should not let their guard down as it relates to making sure that your plans are indeed compliant. Now, CFPB examinations typically include a review of the relevant LO comp agreements and policies, a review of accounting records, and interviews with individual LOs. For lenders, it's important to remember that examiners don't just look at your current LO comp practices, they also look at your past compensation plans to see how they have paid their lenders historically. For this reason, if you think your comp plan may have some compliance issues, it is better to address those sooner rather than later, because what we are seeing in our work is a kind of long tail liability as it relates to non-compliant LO comp plans. In other words, examiners may scrutinize LO comp plans, and they are, that you may have abandoned already years ago. Now you'll see on this slide 4 enforcement actions by the CFPB, all involving compensation to LOs based on a transaction term. In the first, Castle and Cook paid quarterly bonuses that varied based on the interest rate. That's clearly in violation of the rule against basing LO comp on a transaction term. It's worth noting that the president and the senior VP were named in the order. Yes, the Bureau has gone after individuals and not just the companies. In the next, Franklin Loan Corporation used expense accounts from which they paid bonuses. Contributions to the expense accounts were a percentage of retained rebates, which were, of course, based on interest rates. Again, this violated the prohibition against basing compensation on a transaction term. RPM, also had used expense accounts funded by loan profits to pay bonuses. For each loan closed, if the revenue exceeded the sum of the branch fees and the upfront commission the LO earned on the loan, the lender made a deposit into the expense account, which was used as a point bank, quote unquote point bank. And again, the CEO got hit personally. A very, very unfortunate story and situation. In both these cases, bonuses were strongly correlated with balances in individual expense accounts, which in turn were based on the terms of the LO's transactions. The last action on this slide, Guarantee Mortgage Corp, involved the payment of fees to marketing service entities owned by LOs and producing branch managers. Under the agreements, fees weren't supposed to include income from loans they generated, but through their accounting, well, it did. As a result, the owners of the marketing service entities actually received compensation based on the terms of the loans they had originated. All 4 of these actions involved basing LO comp on transaction terms in violation of the LO comp rule. Okay, while you're trying to make your policies LO comp compliant, don't forget RESPA kickbacks again. That was the basis for an action just this past January involving Prospect Mortgage. Like many lenders, Prospect rented office space from real estate brokers. They called them desk licensing agreements. Now, the problem was the space was valued based on referrals and not the market rate. And there was more. The real estate brokers promised to promote Prospect as a preferred lender and endorse them, in fact, actively referred buyers to Prospect's LOs. In some cases, they entered actual lead agreements in which the lender paid real estate brokers for each lead received, who in turn shared those fees with their agents. Now, sometimes they entered MSAs, but payments were actually based on referrals, which they labeled a capture rate, not marketing efforts. Real estate brokers sometimes required buyers to obtain pre-approvals with the lender, and the lender was written into property listings. Then finally, the lender paid for portions of real estate ads on a third-party website in return for being promoted. When buyers clicked on the link and provided info to the agent, if they checked a box saying, I want refinancing, the lender received a copy of the info. And the CFPB never mentioned the LO comp rule. This was just an old-fashioned, straight-up RESPA case. On each of these items, the CFPB determined that the lender was paying for referrals in violation of RESPA Section 8, which again prohibits paying for referrals. So again, don't forget about RESPA, and you have to make sure that you're not just isolating the LO comp rule. You've got to look at this holistically, entirely, comprehensively, and strategically. All right, there's a lot of speculation on what the CFPB change in leadership will bring, and you've heard me talk about this, you've heard others talk about it, but on June 29th, 2020, the Supreme Court of the United States ruled that the single director leadership structure of the CFPB violated the separation of powers of the U.S. Constitution. CFPB Director Kathy Kraninger was a Trump appointee who won Senate confirmation to the position in 2018. She submitted her resignation less than an hour after President Biden's inauguration and at the president's request. It was publicly announced the next day Kraninger had previously scaled back regulations. She had publicly stated she had focused on implementing common sense solutions to complex problems and delivering real value for the American people. Now, Dave Uggio had taken over the Bureau's acting director, moving from his previous role as CFPB's strategy program manager. And he originally joined the CFPB back in 2012 as its first lead for talent acquisition, where he created a recruiting program to support the startup of the Bureau. Now, President Biden proceeded to nominate Rohit Chopra as director, and this confirmation had been delayed, but there has been no other nominations mentioned. Although there has been no official comment, the selection of Chopra signals that the Biden administration plans to return the CFPB to a more prominent role in the early days. And I think this kind of goes without saying. Now, Chopra served as CFPB assistant director and as student loan ombudsman for the agency when it opened its doors back in 2011. Over the course of his entire term at the FTC, Chopra had pushed the agency to become more skeptical of private equity buyers and more aggressive in using its rulemaking powers to rein in businesses. So between the recent request for information and the recent released guidance from the CFPB on it, ATR, QM, deferred action, it'd be easy to speculate that fair lending and unfair deceptive practices, or UDAP, will be in the limelight for the Bureau. Fair lending and UDAP are also likely contenders for the spotlight simply because they weren't in prior years. Now, we mentioned fair lending already, so now we'll go ahead and touch upon UDAP very quickly. UDAP stands for unfair, deceptive, abusive acts or practices. Under the Dodd-Frank Wall Street Reform and Consumer Protection Act, the Dodd-Frank Act, all covered persons or service providers are legally required to refrain from committing unfair, deceptive, or abusive acts or practices. Collectively, these are, again, UDAPs. Now, UDAP is a tool that the CFPB uses when it finds an unsavory practice that it doesn't fit neatly into their other rules. For instance, as mentioned a little bit earlier, if the CFPB were to find that although a company is paying a loan originator the same comp on every loan, the originator is nonetheless steering consumers into particular loans or loan terms that are not in their best interest, the CFPB may look to see whether that practice is unfair, deceptive, or abusive, and whether the company knew or should have known about it. Now, many calls that we receive start with, look, this company down the street, they're doing this. Isn't it against the rules? Why should they be allowed to do this and not me? It's hurting my business. Well, look, the CFPB has put out bulletin after bulletin reminding not just lenders but brokers and all participants in the financial service industry to be cautious about any production incentives they might be offering to their employees or service providers, noting that the risks these incentives may pose to consumers are significant, and both the intended and unintended effects of incentives can be complex, which makes the subject worthy of more careful attention by institutional leadership, compliance officers, and regulators alike. And as we have, really seen throughout the enforcement, the consequences are not minuscule by any means. So what can you do to stay competitive and stay compliant? First, educate your staff and stay abreast of enforcement actions. It helps when the staff understands why these rules exist and can then buy in. Second, create and actually implement policies and procedures. Third, provide transparency on compensation processes. Fourth, self-audit. Fifth, measure more and then compensate based on those measurements. There's a variety of process points that can be measured: quality submissions, compliance benchmarks, almost any objective item other than profit. So even that the LO comp and fair lending rules provide, there's still tremendous room for flexibility in designing an LO comp plan. According to the latest data from the Conference of State Bank Supervisors, there's roughly 145,253 mortgage loan originators licensed through the NMLS. That is a lot of compensation plans to track, even if the plans are similar in nature, because each LO's pipeline is going to vary. And those variances are what make LO comp such a complex function. Now, one last thing, just simply talking about the competitiveness and, relating yourself to Joe Schmo down the street. The bottom line here is, again, you have to look at whether you're in this industry for the short term or the long term. You cannot control what any other party is going to do. They may get a short-term gain, but for any and all of those people on today's call who have been in the industry both pre and post 2008, doing things in a way looking at short-sighted profits is the surest way to ensure that your company does not have the longevity to be one of those that is in the industry 30, 40 years. Now, that's my own recommendation. And when we tell our clients, we give you the good, the bad, the ugly, and you have to figure out what your risk tolerance is. Are you going to survive if you don't do something? There are various needs, but at the end of the day, this is a hot topic, as are others. But really, LO comp, kind of mixes here between the regulatory side as well as your need to compete. You need to attract top talent, and this industry, especially when it comes to LOs, it's a fairly incestuous bunch. They're willing to go to, the grass looks a little bit greener on the other side. They could easily jump and bail. And that brings us to a lot of work we do on prosecuting or pursuing companies who steal LOs or defending those who attract those talent as well. But look, we've gone through lots of various scenarios based on frequent questions that we receive and we routinely work on. One of the things that's great about doing these LO comp plans is that our clients have amazing thoughts. Really bright, intelligent, been in the industry, can strategically think. And after vetting those, we're really able to compare and contrast what works, what doesn't work, and not have to reinvent the wheel here from scratch. But look, if you have any questions regarding today's webinar, please feel free to reach out to myself. If you have any questions about the Mortgage Collaborative, I would urge you to reach out to Tom Gallucci. Great guy, great group. And if you are a member, hopefully I'll have a chance to meet up with one of you or many of you at the upcoming Terranea Resort Conference. And certainly we've got others, MBA Annual, as well as regulatory compliance and so on and so forth. Just to have a quick plug, we do have 2 additional upcoming webinars in the next few weeks. One dealing with transitioning to delegated underwriting and trying to do it and remain very profitable. And then we're also going to have another follow-up update to our previous webinar on marketing agreements, joint ventures, affinity relationships, and so on. And then finally, it hasn't been announced yet, but we will shortly be announcing a webinar on you as a lender just got hit by a ransomware attack. What do you do? It's not a fun situation. It's happening more and more, a lot of it in the news. So if you are interested in that, please look out for our newsletter, the announcements we make on LinkedIn. And, finally, I would just like to again thank everyone for attending today's webinar. We really appreciate your participation, and we hope that this provided you with some value. Tom, thank you and the Mortgage Collaborative for being such a great partner and working with us and participating in these and helping to put these out there. So without further ado, I'm going to go ahead and conclude this webinar. There will be a recording of it. There will be an email that gets sent out with a copy of the deck to everyone who had registered for this event. It's not up here, but if you have any questions regarding that you don't want to do by email, please feel free to call me at 415-246-3995. Thank you very much, everyone. I appreciate your time.